Hello everyone, welcome back to my YouTube channel, The Psychological Investor, where wealth generation is simplified. In this video, I'll be talking about medical insurance. Surprised? Yes, in the first video of my channel, I said in this channel we'll be covering mainly about investments and stock market trading. But now how come I'm talking to you about medical insurance, and that too calling it as a first step and the most important step. It is important even for the people who already have medical insurance covered by the employer, which I will cover in the later part of this video. Let me explain you why medical insurance is very important. See, when you have fever, headache, or any other small health concern, you visit a doctor for a consultation, you shell out some money for the consultation and to buy some medicines. Obviously, the cost of the consultation and the medicines is not a big hole in the pocket. You can manage this cost from your daily expense budget. God forbid the situation should not come, but what if your health concern is bigger and you have to get a surgery done? Now, obviously, the cost of the surgery cannot be managed from your daily expense budget. Then, in that case, you have three options in front of you to pay for the surgery. Either you pay from your existing investments, or you offer a loan, or you have a medical insurance for which then the medical insurance company settles the bill for you. Now, with some real calculations, or let's say financial calculations, I will show you why having a medical insurance is much safer and economically viable. So first, with regard to the savings, here I've assumed that we would be doing a recurring deposit for about 4,500 rupees per month, which sums up to about 54,000 rupees per annum. Here I've assumed the interest for the recurring deposit is about 6.5%. So we get about 1,900 rupees interest for 1 year, which sums up to about savings of about 55,900. In year 1, if I have to incur a medical treatment, that is a surgery cost, it will be about 3 lakhs. I've assumed it will be about 3 lakhs. Now see here, I have a deficit. I have a deficit about 2,44,000. So again, the savings will not be sufficient for me, at least in year 1. Let's say I don't incur a medical treatment in year 1, so I continue to do my savings. So I increase my saving per month from 4,500 to 5,000. So I save about 60,000 in year 2. I get about interest of 2,100. Now cumulative savings from year 1 and year 2, it's about 1,18,000. Obviously, the medical treatment 3 lakh today will not cost 3 lakh tomorrow. It'll increase with an inflation. So it's about 3,18,000. You still be under deficit of about 2 lakh. Let's assume again I don't incur this medical treatment. I'm saved. So year 3, I increase my saving about 5,500. Like this, I'm still in a deficit for year 3 as well. You see 1,50,000. Year 4, I continue. I'm under deficit. Then finally at year 6 is where your savings is sufficient to have a medical treatment, that is a surgery cost. Now it will obviously cost 4 lakh. Like I said, 3 lakh today will not be 3 lakh after 6 years. It will be about 4 lakh with inflation. So imagine today you don't have any savings, and if you have to incur a medical treatment, you will still not be the savings will not be sufficient for you to go ahead and spend about for the surgery for about 3 lakh. So you have to wait for 6 years, for the savings to be sufficient to incur the medical treatment, right? So clearly savings is not a solution according to me. And if you see that, okay, let's assume God forbid nothing happens for 6 years, and then if you have to incur a medical treatment which is about 4 lakh, you have some money in the savings account or the recurring deposit for you to pay out of it. But then still you will be spending about 4 lakh from your savings, right? It will hamper your savings, it will hamper your portfolio, and you have to shell out about 4 lakh. Let's move on to the second option, which is of taking a loan. So I've assumed that we take about 5 years of loan. 5 years of loan, monthly EMI is about 6,500, and your annual cash outflow for the year is about 78,000. You will have to pay the interest, which is about 11%. I've assumed, again, it's an assumption, but more or less the personal loan today is at 11%. It's about 91,000 is the interest value, and the total outflow, again, it's an outflow of about 3,91,000. If you can clearly see that I'm shelling out about 3,91,000, also the interest of 91,000, which is included in this 3,91,000 to do to go ahead with my surgery or to pay for my surgery cost. The third option is what I said is about medical insurance. So if I take a medical insurance, I have taken, let's say, for a cover of about 3 lakh or about 4 lakh, and you will incur about annual premium of 11,000 rupees. So year one you pay 11,000, and in case you have to get a medical treatment done, which is about 3 lakh, it's okay because it is covered in your medical insurance. So I say savings, but it's not actual savings, but for 11,000 you get, let's say you get a coverage of about 3 lakh. Year two, I've assumed the premium is increasing, but in most cases the premium doesn't increase to about 5%, but I've assumed worst case the premium increase. Again, in the same assumption, medical treatment obviously will increase with the inflation, so 3,18,000 you're still okay because you have the medical coverage here. So you don't have to shell out this 3,18,000, you just have to shell out 11,550 for you to have a medical treatment of about 3,18,000. So here you see year 5, year 6. So overall for 6 years I will be shelling out about 74,000 rupees, and I could get a medical treatment worth 20 lakhs. Okay, so if I take the ratio, it's about only 3.6% of my medical treatment. I just have to shell out the annual premium. Now again, if this is no claim, I know that people will say, okay, I had no claim, but I'll be wasting about 74,000 rupees. No, you don't have to look at that. It's not wastage of money. It is to secure yourself. It is to really secure yourself from any medical emergency. And like you see, if you have any medical emergency, look, you have to shell out from your savings. It's not a small amount. It will be about 4,28,000. If not savings, you will have to take the loan. It's not good to pay so much of interest, and it's not good to pay 3,91,000 also. You could rather use this loan, not the loan amount, but you could rather do an recurring deposit and earn interest out of it instead of paying interest to the bank. So, and then the third option, I told you it's the best option, is the medical insurance, and I've shown you economically also it's quite viable. You just pay a small premium amount for you to secure, let's say for you to secure in terms of any medical emergency. You don't have to think about it that, oh, what I have to pay out of my savings, or I have to take the loan. It's a peace of mind. You have a medical insurance and everything is sorted. Now that it is clear, having a medical insurance is the best option. There will be still a doubt on people, what if I have a medical insurance provided by my employer? Then in that case, first check who's covered. Is it only you, or it's you plus spouse plus children if any, or if it is you plus spouse plus children plus your parents? For me, irrespective of who is covered, I think you should still have your medical insurance of your own. Let me explain you why. What guarantee it is that you will continue under employment for lifetime? What if you decide to do something on your own? Let's say at the age of 25, okay, or at the age of 35, suddenly you will be without any medical insurance cover. Now, taking the insurance at an early age is much better, because you will see economically it makes a lot of sense if you take insurance at an early age. Now again, what guarantee that you will do something of your own at an early age? What if you decide to do at the age of 35? You will have a lot of these doubts. So now let me show you with an example. So let's say I've taken an assumption that I've taken a medical insurance cover of about 5 lakh. I've taken it for myself plus spouse. I live in a city, Bangalore. Okay. So now first assumption is I decided to do something on my own at the age of 25. Okay. So then I have to buy a medical insurance. I pay an annual premium of about 8,000. So cumulative outflow, cash outflow for year one, that is age 25, is about 8,000. Year two, my insurance premium increases to about 8,500. then cumulative saving, let's say cumulative cash outflow is about 16,500. That is for the age of 25 and when I age of 26, 2 years together, there's a cumulative cash outflow of about 16,500. But yes, there is an outflow, but you had a insurance cover of about 5 lakh in each year. You see here, age 27, I've kept the same premium. This is a live example. This is an actual example. The premium will not increase year on year. Okay, there are 99% of the insurance companies have this age bracket. Let's say from the age of 26, you see here, till the age of 35, the premium remains the same, 8,500, and of course the cumulative cash outflow will keep increasing. But there's an age bracket. Within that age bracket, the premium remains the same. So I've assumed that until the age of, let's say, 55, the annual premium, let's say the annual premium for the age on the when we are at age 55, we do about 20,500 is an annual premium, and total cumulative cash outflow from the age 25 to age 55, it's about 3,82,000. And you know, every year you get a cover of about 5 lakh rupees. Now, second assumption, what if I decide to do something on my own at the age of 35? I leave the employment and I do something on my own at the age of 35. Here I've assumed that we'll have a pre-existing disease. Either I would have BP or diabetes. In today's lifestyle we live in, it is common to have this kind of disease. So I've assumed, it's a worst case, I've assumed that let's say I have a BP at the age of 35. Having a pre-existing disease, the premium increases. You see here, now at the age 35, I have to shell out 14,880. You compare to the age of 35, if I would have taken here at the age of 25, I would have started the medical insurance premium at the age of 25. I would have shelled about 8,500. Now I have to shell out 14,880 for the age of 35 here. Now here I continue. Now if I compare until the age of 55, my cumulative cash outflow is 4,45,000 in this case. And here, if you compare, if I have taken the medical insurance at the age of 25, you see my cumulative cash outflow is about 3,82,000. So I will be paying about 16% more. Now again, I've assumed at the age of 35. What if I take the medical insurance not at the age of 25 but at the age of 45? You can imagine you would be paying at least 25 to 30% more than what you would be paying if you take a medical insurance at the age of 25. So it is really critical for you to take a medical insurance at an early age, so that then your total outflow throughout your lifetime is not high. If you take at the age of 35, you've seen it, it's already 16%. You can imagine if I take at the age of 40, it will definitely be about 22 to 25%. And then so on, if you start to take at the age of 40 or 45, it will be about 25 to 30%. So it is very, very important for you to take a medical insurance at an early age. This is why I said, irrespective of your employment, you should have a medical insurance of your own.